So what's next for the stock market? We have come a long, long way over the course of the last few years. Look at the Dow. The Dow has finally surpassed that 20,000 milestone. So the markets have come a long way. How much gas is actually left in the tank? Look at this graph. Look at how far the S&P has come since the March 2009 bottom. Through the end of 2016, it was up 231%. That's astounding. That completely demolishes the last two bull markets, which were up 106% and 101% respectively. So does that mean that the market's overdue for a crash? Not necessarily. What are some of the big differences between this bull market and the last few? The biggest difference is this prolonged zero interest rate environment that we've been experiencing. Look at the 10-year Treasury in December of 2016. It was down at 2.5%. It was 4.7% in 2007 and 6.2% in 2000. Why does this matter? Because capital chases yield. What does that mean? Do you remember when CDs were paying 5 to 6%? Where the heck can you find those anymore? So here's what happened. The people who used to buy CDs began buying bonds so that they could get a better yield when CDs started paying 1 or 2% instead of 5 or 6. As bond yields came down, they continued to move up the risk ladder into dividend-paying stocks, and then eventually growth stocks. And then all of a sudden, they're chomping at the bit to get some Snapchat IPO when that rolls out. So unfortunately, you've had people who were very conservative investors continue to move up that risk ladder. As long as interest rates remain low, dollars are going to continue to chase yield, and they're going to remain interested in stocks. So there's definitely some gas left in the tank here.
As you can see, this is the second longest bull market on record and the greatest bull return ever. The average bull market lasts 54 months, and through the end of 2016, this was 95 months long and still going strong. The average return is 154% for a bull market. The return on this bull market through the end of 2016 was 231%. So the biggest question right now is the market overvalued or undervalued?
Most common valuation metrics will make it appear to be overvalued. The latest forward PE ratio as of the end of 2016 was 16.9. And a PE ratio is the price to earnings ratio, which is essentially how much an investor is willing to pay for every $1 of earnings that company generates. So at 16.9, that means that the investor is willing to pay $16.90 for every $1 in earnings that are generated by the S&P 500. Now that forward PE of 16.9 is above the 25-year average of 15.9. And the way this works is the higher the PE ratio, the more expensive the market is. That means that investors are paying more money for every dollar of company earnings. The problem with that is it really ignores the current macroeconomic landscape. Remember, I talked about capital chasing yield. The best way to look at this is by using the Fed model. The Fed model says that the market is undervalued as long as the earnings yield on the S&P 500. So what is the earnings yield? That's the reciprocal of the PE ratio. So the PE ratio is price over earnings. The earnings yield will be the opposite, earnings over price. So when the earnings yield of the S&P exceeds the 10-year Treasury yield, that's when we know that the market is undervalued. Now, one of two things will happen to make the market overvalued. Either interest rates will go up or the earnings yield will go down. So right now, with a PE ratio of 16.9, that gives us an earnings yield on the S&P of right around 6, if we look at the reciprocal. And the current 10-year Treasury yield is below 2.5%. So right now, relative to bonds, stocks appear to be undervalued. Despite the fact that most market metrics will say that the market is overvalued, Look at the graph on the left. It shows that based on the current forward PE ratio of 16.9, subsequent one-year returns are typically in the high single-digit range, which is awesome performance. Furthermore, if you look at the one on the right, the subsequent 5-year performance on an annualized basis is also in the high single digits. So taking history into consideration, it looks like we've got some good years ahead of us. And look here, most people don't realize it, but there's almost always a positive relationship between interest rate movements and stock returns, as long as the yield on the 10-year Treasury is below 5%. That's the key number to pay attention to, 5% on the 10-year Treasury yield. Now, once the yield surpasses 5%, you can see that the relationship inverts and the stock market typically begins going down as interest rates continue to rise. So that is one of the most important things that we're paying attention to is the 10-year yield. As it approaches and passes 4%, we'll really need to hone in on some risk management techniques to make sure that we are ready for any potential market correction.
That's why it's so important to work with a proactive wealth advisor, somebody who's keeping up on these lead indicators, somebody that's doing their homework, reading their research, understanding what the next moves need to be. The last thing you want to do is work with somebody that puts you in a bunch of mutual funds and is off on the golf course working on their handicap. It is paramount that you work with somebody that's being proactive and setting you up for success.
How well are you managing your wealth? Are you taking advantage of all opportunities that are available to you? Just as it makes sense to have regular physical checkups to make sure you're maintaining optimal health, it also makes sense to do a regular checkup on your financial situation. Our Wealthalize tool will provide you with that diagnostic. Simply complete our online questionnaire in under 15 minutes. Our proprietary software will analyze your investment strategy, tax situation, asset protection, estate planning, charitable giving, and your professional relationships. You'll immediately receive a score ranging from 0 to 100, which assesses your situation. Additionally, you'll receive a SWOT analysis, which identifies your strengths, weaknesses, opportunities, and threats that could impact your wealth management. Visit today, www.wealthalize.com.